Hi there everybody, a new video for a new pre-scene because a new case study is upon us. So if you're preparing for the May 2025 or the August 2025 operational case study exam, this pre-scene analysis video is going to form the backbone of your study prep. Now, as we all know, the pre-scene company is the company on which your exam questions are going to be based. You are going to be asked scenario type questions based on this pre-scene company. So it becomes ever so important for us to analyze this company first, second, understand the functioning of this company, and third, try to pick out E1, P1, F1 themes or syllabus areas which can be tested upon in the exam. All of these three is something that we focus on in our pre-scene analysis. We are CIMA registered tuition providers, and since the past 2 years, 2022, 2023, and soon for 2024 as well, we will be awarded the Global Pass Rate Excellence Award, which further means that any instructions or any case study themes that we point out are credible, do come up in the exam, and that is further supplemented by our high pass rates. So this is pre-scene analysis part 1. Before I start with my pre-scene analysis, let me just tell you that to help all of our students, the entire CIMA community, we have a free study course, which we are calling the free case study mini course. This mini course is revamped. It's very specific to the May-August attempt. It will provide you a whole bunch of free material, which includes the industry analysis, the blueprint explanation video, the top 10 issues discussion, the mock writing tips. We'll give you a free mini mock for you to write, for you to test your knowledge. We'll help you create your study plan and a whole lot of bonus material which you will find incredibly helpful for your exam prep. Even if you're self-studying, you're studying with any method, this free mini course is bound to help you. The link is in the description below. It's absolutely free. Give it a shot, and for sure you're going to find it helpful. Without further ado, let's start with this pre-scene analysis. So we'll start with your role. What we'll do is we'll run through every single line, every single part of the pre-scene analysis that has been released by CIMA. We will not miss out on anything. So this one document will provide you with all the knowledge that you need, all the information that you need about our company, Halfpenny. While I go through the pre-scene with you, there are some things which you should be very clear of. First, I will be continuously making links to E1, P1 and F1 syllabus areas. These are key areas of focus which you must be careful of, which you must revise, and which you must be making a list of. So when I mention one area, you should write it down. So point number 1, let's say activity-based costing. I was discussing activity-based costing, you write it. Second, zero-based budgeting, you write it down. That way you should have a full list of topics ready when you finish this pre-scene analysis, because these will be important topics, key topics which will help you focus on the key areas before we actually write mock questions on them. So you're learning the pre-scene, you're highlighting the key topics, you're revising those key topics, then you're writing mock questions on those key topics. You're going to be very well prepared for this exam. That is why a whole lot of time and effort has gone into creating this pre-scene analysis for you. This is not something that we have done overnight. A lot of time, effort, presentation we have put in to make this document very understandable for you. So we'll go through everything carefully. Please pay attention. So you are a finance officer working within the finance department of Halfpenny. So whenever I find something important, we will highlight it and we will discuss it. So you might be wondering, what is the role of a finance officer? So finance officer generally helps with short-term decision making. that ties into your P1, E1, F1 syllabus. A finance officer deals with cost analysis, variance reporting. Variance is the very important part in your P1 syllabus. Effective working capital management, very big part of your F1 syllabus. Receivable cycles, trade, your payables cycle, your short-term working capital. Next, preparing financial reports and documentation. So your IFRS, IAS in F1 become important. Ensuring compliance with accounting standards, again F1. Budgeting and cash flow, P1. Providing regular financial analysis, again P1. Now, why am I giving you this? These are not important topics. This is just pointing out clearly to you that the role of a finance officer is very much interlinked with your E1, P1 and F1 syllabus. So if you know your E1, P1 and F1 syllabus well, you will be able to do the role of a finance officer much better. You will be able to serve Halfpenny much better, and then naturally you will be able to write better answers which will get you good marks and help you pass this exam. So the role of a finance officer, which I have explained earlier as well in my starting early video, in my introduction to the OCS exam video, P1 is the most important pillar of this exam. You should attack that first, then continue your other revision in the background, because without revision, becoming a good finance officer is not going to be possible. So you are principally involved in the preparation of management accounting information and providing information to managers to assist with planning and decision making. You don't have to make the decisions. You have to assist with planning and decision making and provide them the information, provide them the explanations. So P1 syllabus coming to the fore again. Now, at times you are also expected to assist with the preparation of financial statements and answer queries regarding financial reporting. So if a query is raised to you on financial reporting, your F1 syllabus comes into the picture, and for any case study exam, it will be important to immerse yourself into the details of this company. Only then you will be able to present answers which are good, solid, which are well interlinked with the pre-scene, and it will give you good marks as well. So very important to understand that your role is that of a finance officer. The role of a finance officer can only be done well if you have good E, P and F knowledge. That was your role. Now starting with company background. So Halfpenny is a company that produces and sells packaged bread. We already know the details of the packaged bread industry because we have done our industry analysis. The value of the industry analysis is very clearly seen and visible over here. Those who have not done my industry analysis, I recommend you to first get that done. It's part of the course. The industry analysis is very important because it gives you an insight into the packaged bread industry, which all of us have limited knowledge of. But when you've done the industry analysis and then you jump into the pre-scene, you have lots of ideas in your mind. So Halfpenny is a company that produces and sells. So you produce and sell. So you are part of an organization that manufactures and sells. So when you are doing your E1, P1 and F1 revision, now your mind will be very alert to topics based on a manufacturing environment. I will not say that you completely leave out topics which are based on service organizations, but you will be more aware of concepts which are relevant for a manufacturing organization when you are doing your E1, P1 and F1 revision, because that is the company that's been given to you. And naturally, I will be discussing all the important topics for you through this pre-scene analysis. So you don't have to worry, but this is just a heads up which I like to give. Now, the company operates as a vertically integrated organization controlling all stages from design to sales, which means you design your product, which in this case is the bread, decide what the bread is going to be, and then you sell it. So, this is an in-house approach, which has a lot of advantages as well as disadvantages. Because you produce as well as you sell, you have good customer knowledge. You have a direct sales channel, there are no intermediaries. Disadvantages will be you have increased capital requirements. You need more capital because you are producing as well as you are taking part of the sales, you are taking part of the distribution. It gives you less flexibility to change your strategies. But at the end of the day, it helps you manage your supply chain in a better way, because you can decide where you want to give how much, where you want to sell how much, which part of the country require, what demand is there, how you want to supply to that demand. You have a lot of strategic flexibility in that case. So important for us to know that as of now, it's an in-house vertically integrated organization where you produce as well as you sell. The company is based in Kieland, a small country in Europe where the currency is K dollars. Now, Halfpenny operates in Kieland. It's a domestic market, but as a small country in Europe, there are many opportunities to expand internationally. So this links to your PESTEL model from the E1 syllabus. Remember, right now you are based in Kieland. There can obviously be a situation where you start to expand outside of Kieland. So you need to keep track of your global trends. You need to keep track of external factors which will help you expand, and that is where the PESTEL analysis comes in. But so one thing was that we are currently based in Kieland, so there is an expansion opportunity, PESTEL. Second thing, because you are currently based in Europe, there are a lot of avenues which this is opening up. Firstly, Europe itself is a developed economy, so it's a good opportunity for Halfpenny, because consumers will already have disposable income. They will be interested in high quality specialized breads, which we have learnt about from our industry analysis. So because you are in Europe, you have the advantage of a developed economy. You have the advantage of an established bread culture. Europe, major parts of Europe have already a strong bread eating tradition, which means people are already buying bread, market is already there. On the other hand, there is cost and regulatory considerations. Obviously, Europe as a country is expensive, labor is expensive, food and safety regulations are expensive, labeling requirements are expensive. So there is a downside as well. Segmentation and external market analysis will be important over here. Who are we focusing on in our market? Is there an opportunity to expand to other parts of Europe? That is what we are thinking of when we read this one line. So you see, when you do my industry analysis, then when you come to my pre-scene analysis, and all of these topics are coming up in terms of relation, a lot of stuff is making sense. So you should have in your topic list listed down first external factor analysis PESTEL E1. This way the topic list should continue. The company was founded in 1891 when Martha and Bert Halfpenny started baking and selling bread and other bakery items from a single small bakery store. So company was founded in 1891, which means your company name, your business name has been in the market for 134 years. You imagine any business, this becomes a legacy business. Any business in the world has survived for more than 1 century. Why? Because it has loyal set of customers. It has a huge brand image, and this amounts to increasing goodwill. So always remember this as a fact, that you have been in the market for 134 years, you have survived recessions, you have survived booms, and the company is still going strong, which means you have a loyal set of customers and goodwill of the company is very strong. Now, one tip which I'll give you over here is, see, we are understanding the pre-scene, yes. We are linking to E1, P1 and F1, yes. But all of this information which I'm giving you will also help you, let's say, make your answers more integrative when we go to mock question writing. How? Because whenever you are writing anything, you can start your answer or end your answer by saying we have been in the market for 134 years, which says a lot about our company's culture, our ethics, for example. You include those 1-2 lines in your answer, it tells the examiner that this person has studied the pre-scene. This person knows the company. This person inside out has paid attention to the company's details. Like this, if you use subtle variations from the pre-scene within your answer, it tells the examiner that, okay, this person knows what they're talking about. This person is ingrained within this company's culture. It will add a whole lot of value to your preparation. So also very important to note over here that Martha and Bert started this business. So it is a simple, flat organizational structure. Decision making would have been centralized. These two people make all the decisions. And the key stakeholders at this stage were local customers, local suppliers. Remember, this relates to E1 types of organizations, right? At the beginning, it would have been a flat organization, one person at the top, or let's say two people at the top making all the decisions. By 1905, there were 3 bakery stores, and by 1912, there were 10, all within 20-kilometer radius of the first. So we started expanding. 1905, 3, 1912, 10, within a 20-kilometer radius. Smart. So expansion to multiple stores suggests a decentralized retail operation, but still local. So you have retained the flat structure in your early stage. Very simple, because just because new bakeries are coming up doesn't mean your structure changes. These two people were still leading the organization. It was very flat. Expanding to 10 stores then would have required sales, cost forecasts to support your budgeting for inventory, staffing, operations, because naturally an expansion comes with its own problems of costing, own problems of inventory, own problems of staffing, especially for small companies. So your budgeting concept, P1, comes into the picture over here. I'll be more specific about types of budgets deeper into the pre-scene, but just because an expansion is happening, it's important to be aware that the company survived these challenges. And obviously when you're expanding, you need more money, so working capital needs, more inventory across different stores, more receivables, more managing the payables. This is also something that the company survived. So when we expanded, flat structure was retained, budgeting problems were dealt with, and working capital problems were dealt with. So this is within the culture of the company. Expansion is not new for this company, let's put it that way. In 1916, production of all bread and bakery items was moved to a single purpose-built factory. So there was a new factory that we built in 1916. All the production was taken there. All the production was happening there. Very important relations coming up, because we built a new factory, so this was a new avenue for the company altogether. First, this relates to your value chain. If you think of the Porter's value chain from your E1 syllabus, next topic, Porter's value chain, you start to relate over here because operations become centralized. Outbound logistics also gets affected, because from one place you have to distribute now to your 10 different stores that we have currently. But this can enhance, because it was single purpose built for only production, this can enhance your quality. This can enhance your control. So total quality management becomes better. Also, because you built a new factory altogether, it was purpose built. So this factory becomes your property, plant and equipment. It appears on your statement of financial position, and it will need depreciation, ongoing asset management, buying of new machines, selling of machines. This relates to your IAS 16 non-current assets from your F1 syllabus. Next, P1, a single production facility, meaning we are reliant on one production unit. When we make any production related decisions, it is important that relevant costs are considered. Now it's one factory, one single built area where you are producing. So if you produce one product and don't produce another product, there is opportunity costs which are coming in. So relevant costs need to be considered. So because of one area, one word, single purpose built, we were able to make so many relations. Why? Because I am here as an expert pointing out these important areas for you so you don't miss out on anything. Now the company continued to grow steadily in the 1920s and 30s, and by 1940 the bakery had been expanded and the number of stores was 30. So by 1940 you had 30 stores. Again, expansion taking place. This specifically I will relate to budgeting and forecasting, because managing 30 stores requires more sophisticated budgeting techniques, such as rolling budgets. Up until now, you were a small business. As you're becoming large, you may need to consider rolling budgets, activity-based budgeting, sensitivity analysis. These are important aspects because the business is growing. Also, because now you have 30 stores, it will be difficult to manage labor, sales, your input, your materials. So your variances start to occur at this stage. So very important to study the variances topic. The next topic becomes your budgeting methods, like we mentioned over here. Variance analysis. I will also speak about this in detail, but as and when things come up, I am pointing them out to you so that we have a solid list of topics from the very start. In 1948, Joseph Halfpenny, the grandson of Martha and Bert, became managing director and majority shareholder of the company. So 1948 was when a change came. Joseph drove significant change in the company, and by 1952, the company no longer had its own stores and was entirely focused on production of bread. So your 40 stores which we had expanded to, 30 stores that we had, which we had expanded to, no longer existed in 1952. Joseph came in, he sold the stores, and we focus only on production of bread. So you became a company that produces bread entirely, which was sold to grocery stores in central Keeland. So from our completely vertically integrated model, where we used to produce, we used to sell directly to the customer. Now we have become a production company selling to grocery stores, and these grocery stores will then sell to a customer. So an intermediary has come in. So there was a transition from the vertically integrated to a specialized production model. So organizational structure or selling structure somewhat changed. This gives rise to the most important relationship for your business, which is supply relationships now. Because Halfpenny pretty much outsourced. Outsourcing is your next topic. The retail function by supplying grocery stores. So your relationship with these suppliers will be very, very, very important now. Also, because your relationship has changed with these suppliers, with this outsourcing model coming in, Joseph's strategy requires new sales forecasts based on wholesale pricing models rather than retail pricing, because you're not selling to the customer now directly, you're selling to the supermarkets. So your pricing model also changed. And obviously, this gives rise to trade receivables from grocery stores rather than cash directly from customers. Now there are trade receivables, so working capital management becomes more important. You see how the strategies of the business are changing? From when it started to 1952, there was a huge change. So until 1952, all bread loaves sold by Halfpenny were unsliced and unpackaged. In 1952, Joseph invented in what was at that time state-of-the-art machinery to slice and package loaves in halfpenny branded waxed paper. This innovation coincided with advancements in the ingredients used in bread production, which extended the shelf life of a bread loaf. So in 1952, a huge change again came for the business in terms of its packaging. So new packaging, new machinery, new advancement in ingredients, a lot of changes happened. As we know from our industry analysis, innovation is the backbone of this market. So at this stage, the company gained competitive advantage by innovating. Second, we entered the brand marketing situation because everything now had Halfpenny written on it very clearly. Also, in this situation, activity based costing could have been something that was implemented. We'll speak about costing later on in the pre-scene. But right now, I feel because the company is changing, there was an opportunity for activity based costing because at this stage, costs could be allocated or associated with the new machinery because specific operations, specific activities like slicing, like packaging came into the situation. And at this stage, premium pricing could have also been considered because innovation, new ingredients. So P1 is at the center of this innovation if you're paying attention to me, obviously. And then naturally comes F1 because a new machinery coming in, new machinery was invented. So this new machinery is your IAS 16, again, property, plant and equipment. Also very important, IAS 2, inventory. Advancements in your bread shelf life extending affects this inventory valuation. Products can now be stored for longer, reducing your wastage and lower inventory turnover ratios. Making sense? So all of this you only pick up if you're studying the pre-scene with us. Otherwise, these details are simply overlooked. These topics are simply overlooked. Throughout the 1950s and 60s and 70s, the company continued to grow steadily. The early 1980s was a period of rapid growth for the company, principally due to the boom in supermarkets. Now, supermarkets were a major boom in the 1980s. We supplied to supermarkets, so the supermarkets market share was going up. Our market share was also going up. So over here, very clearly, working capital, because growth impacts inventory levels. You need more. You need to supply more, so you need to make more. You need more money tied up in inventory, more money tied up in materials. So something working capital is a big consideration for our company. Very important topic because every single company goes through ups as well as down. In 1980s, there was a boom in supermarkets. So the time series analysis. So let's say responding to supermarket demand would require a good forecasting technique. Let's say time series analysis is used to plan production accurately. In 1980s, this was the situation. What if they say in an exam scenario, in 2025, there is a huge supermarket boom. We want to use time series analysis to plan our production. It can happen again in a new exam scenario. So studying time series analysis, what the trend analysis means, what seasonal variations mean, is very important, and this hint has been given to you in the pre-scene itself. So time series analysis, an important topic. Increasingly, Shoppers wanted the convenience of a single store for all of their food needs and moved away from high streets and small independent grocery stores, which were often in out-of-town locations. So this change requires understanding market segmentation. If you have not segmented the market properly, you don't know where the demand is, you don't know where to supply, you don't know how much to supply, you don't have those details. Now, moving to supermarket supply models, again, like we spoke above, changes your pricing, because earlier you did retail pricing. Now you are doing wholesale pricing. So your pricing strategies from P1 become important because your nature of business is changing. During this period, Halfpenny, with Paul Halfpenny, Joseph's son, as the managing director, secured contracts with 3 leading national supermarket chains to supply them with packaged bread loaves. So during this period, during this boom, we secured contracts with 3 leading national supermarket chains. Very important. Now, as the company grows, it may rely more on data gathering. So your data techniques from E1 are becoming more and more important because this data will help you forecast demand, better manage production, better manage your capacity. So this data gathering is important and it's coming into our, and I'm pointing it out from now itself. Deeper on in the pre-scene, we'll see if Halfpenny is actually using data for any strategic decisions. But you should be aware of it right now itself. Now the company's transition from steady to rapid growth means budgeting techniques will have to improve. I've already spoken about budgeting techniques for you, but rolling budget specifically is something that I'm pointing out from your P1 syllabus over here. In 1985, the company relocated its bakery to a new production facility. So, new production facility coming up. This has been expanded over the years, but is still the location where all the company's products are made. This is a very clear indication that I am getting over here. Let's go one by one. Now, this supports continuous improvement initiatives because you are relocating and you are expanding on that particular business area, production area. Very important indication which I am getting over here is that they have said that still the location and it's been expanded over upon years. So initially this is your new production facility, so it's new IAS 16 asset that you have registered. But what if they ask you for a new, because it's already been expanded upon, now we have a new, now we have to sell this, so IFRS 5, non-current asset held for sale, and then make a new factory because now it cannot be expanded upon anymore. Could be a situation in the exam, right? So your IAS 16 knowledge, your IFRS 5 knowledge, the revaluation knowledge, because before you sell, you will have to reevaluate. So your revaluation knowledge, very, very, very important. IAS 16 is an important consideration. Next, physical capital maintenance ensures that facility is capable of ongoing production. So if it's not capable of ongoing production, you might need a new facility. Another situation coming to my mind is events after reporting period. Now, any expansion decisions or significant investments related to production facility made after the reporting period may need to be disclosed as an adjusting event, non-adjusting event. This is often a situation in the exam. They'll tell you that the year has ended, but a major significant investment decision has been held. Does it classify as an adjusting event, non-adjusting event? It will be important for us to know that classification from the F1 syllabus. Now, this is in Central Keeland. So this new facility is in Central Keeland. The company also has a distribution center opened in 1999, which is next to the production facility. So we have a new production facility, we have a distribution center, two assets. So IFRS, IAS 16, coming into the picture. Now, P1 linkages. Now, the decision to locate the distribution center next to production could be optimized using linear programming, LPP, minimizing your distribution costs and maximizing efficiency. What does LPP do? LPP is a model that you use when you have many limiting factors, but you are not able to make the best decision for your company. So how do you make the best decision for your company in a situation where there are many limiting factors? Linear programming problem comes into the picture. I will discuss it very much in detail, but because they said that distribution is now located next to production, it came to my mind. I'm putting it over here for you. IFRS 16 also we have to consider leases over here. Now if the distribution center or its transport vehicles are leased, they can easily tell you in the exam, right? They've not provided any details over here, but they'll tell you that now we have leased 10 trucks for distribution. How will we record this? So your right of use of assets, your lease liability, your IFRS 16 knowledge becomes very, very important in this situation. The next topic, you should have written down IFRS 16 already. All of these topics that I'm coming up with, you should have written down. Halfpenny currently produces a range of sliced packaged bread loaves and packaged bread rolls. The latter added in 1999. So we have a range of packaged bread loaves and packaged bread rolls as well. Until recently, senior management has focused on these core products, continually striving to improve taste, texture, and shelf life. So again, if we look at our relation to syllabus areas, E1 coming into the picture over here, continuous product refinement, deals with product development. Halfpenny is in the maturity stage of the product life cycle for these core products. Remember that these core products are running from a very long time. They are in the mature stage. You will need to continuously find new products to make sure you have products in the growth stage as well to push the company's growth. So innovation, continuous innovation will be further important for the company. Also quality measurement, because you are enhancing the shelf life, it requires investment in quality controls. It requires investment in prevention costs, appraisal costs, so that your internal failure and external failure costs are less. These are from your E1 syllabus, again quality measurement. And because we are talking about life cycle, these products being in the maturity stage, life cycle costing, managing costs of a company over the entire life cycle from development through production to post sales is an important consideration when you invest in any new product. Recently though, as a result of a slowing down in growth, consideration has been given to extending the product range. Like I said, your major products are in the maturity stage. They don't have huge growth. So you will need new products in the growth stage, and the company has recognized this. So before committing to a new product line, Halfpenny would likely use sensitivity analysis to assess how different variables. For example, if I introduce a new product, what's going to happen to the demand? If I introduce a new product, what's going to happen to the cost of materials? Impact the profitability of the new products. So very important that sensitivity analysis is revised here. Also, extending the product range introduces risk. Decision trees can help model potential outcomes and can help you understand risk better, because it's very clear that new products are going to be launched. Sensitivity analysis, decision trees, payoff tables as well can be used in this situation. This is from your P1 risk related chapters, a very important consideration. To this end, Harry and Chang Harry Chang has recently been appointed Product Development Director. Product development is so important for our company that we have a new director for product development altogether. Showcases the company's very straightforward need to develop new products. Now, because there is a director who is looking at product development, his goals, his rewards, his KPIs should be linked with product development milestones. So your reward systems, your KPIs coming into the picture over here. Also very important, there is a new department altogether. So zero-based budgeting could be used. A zero-based budgeting approach may be used in product development, where every new expense must be justified from scratch. Because there is a new product development director, this could be a suggestion. So this should be something that you have revised. Halfpenny is still owned by the Halfpenny family, and two of Paul's children now run the company. Trey Halfpenny, Managing Director, and Rosa Grimble, Sales and Marketing Director. These people are running the company. It's a family-owned business still. In the latest financial statements, revenue was 332 million. Gross profit was 90 million. Operating profit was 30 million. A large company, and the company has 2,208 employees. So it's further evidence that we are already a large company. The company will continue to grow, so the management of the company and having good control over costs and the topics that we have discussed will be very, very, very important. Next, we are going to the bread industry in Keeland. Now, bread is a staple food in Keeland. As we know from our industry analysis and all the discussions up until now, Europe has a strong bread eating culture. The market was worth over 2.5 billion in 2024, and the products included in this are bread loaves, bread rolls, and specialty bread items such as pita bread, crumpets, and English muffins. So very clearly that we are part of an industry that is huge, 2.5 billion, that is growing, and we are in a country that has a strong bread eating culture. Like we already know, bread, loaves, or some of our products are in the maturity stage. What we will have to consider over here is sales mix variance, because we will have a different mix of sales. Different products are selling in different numbers, so we will have to make a mix analysis. So sales mix variance becomes an important consideration over here, because our company will have different bread products. This will tell us which products are selling more, which products are not selling, and accordingly we can decide our sales strategy. Same way, in this situation, because we have multiple products, we will be having multiple products, a multi-product break-even chart could be important to understand the contribution margin of each type of product. Which is more profitable, which is less profitable. So a multi-product break-even chart could be useful in this industry, because companies will have different products. So your new topics coming up here are sales mix variance, multi-product break-even chart. You should write them down. Next, there are 3 categories of bread producers in Keeland. Large plant bakeries is the first one. These are mass producers that make pre-packaged bread products with an extended shelf life. Typically sell products business to business rather than direct to customer. So pretty much Halfpenny is falling in this category, because we are a large plant bakery. We don't have our own stores. We are selling directly to the supermarket. So in this case, I am considering throughput accounting, because the focus is on maximizing throughput for these companies, minimizing bottlenecks to produce as much as possible to give to my supermarket partners. In this case, it's going to be high capital intensive. Like we have learned for Halfpenny, we have our own production facility, distribution facility. Capital intensive nature is high. Break-even point is also high, but profitability scales rapidly once the fixed costs are covered. That's my business model. Remember this. Next, in-store bakeries. Located within supermarkets, they are baking daily. They typically sell products which are unpackaged and so have a shorter shelf life. Sales are business to consumer. Over here, business to consumer. In this situation, we are considering the 7 P's of marketing because over here, place is a critical success factor. Their place is inside a supermarket. Our place is completely different. And their business model altogether is different. Next, third category is high street and artisan bakers. Now, small scale producers that make unpackaged bread products with a limited shelf life, their sales can be business to business and business to consumer. Again, they are the new type of bakeries with new innovative products. These are small bakeries which leverage social media, word of mouth marketing to gain their customers. So 3 major categories. First one, large plant. Second, in-store. Third, high street. Halfpenny falls into the large plant category. The market share of each category of producer in 2024 was as follows. They've given you the breakdown. By volume, 80% of the bread sold in Keeland is sold by large plant bakeries, 15% by in-store and 5% by high street artisan bakers. So the category that we are in is the largest category by volume. By sales value, if you look at it, 70% was for large plant bakeries, 22% for in-store and 8% for artisan. What is this telling us? This is clearly telling us from E1, P1 combined, Porter's 5 forces needs to be considered over here because this is going to be a highly fragmented and a highly competitive market. We should be very aware of this because there is a very straightforward threat of substitutes. Consumers may switch to in-store or artisan bread if they feel that their quality is higher than your quality. So over here, the choice is between differentiation and cost leadership. Large plant bakeries generally would follow cost leadership, high volume, low prices for their maturity stage products like your normal bread loaves. For new products, for new innovations and for in-store artisan bakers, they want to be different. So they will have a differentiation strategy. So remember, something new can command differentiation, something old, something in its mature stage will have to be cost leadership, P1. There are 5 large plant bakeries in Keeland. So 5 players are controlling 80% of the volume. Remember that. That is very clearly visible because of this chart. 4 of these large plant bakeries, one of which is Halfpenny, are well-known brands in Keeland and produce bread which is only sold under their respective brand names. So 4 of these are large, one is Halfpenny. They sell under their respective brand names. The other large plant bakery makes bread for supermarkets. Then the supermarket will put their own branding and sell it. So there are 5, 4 put their own, 1 sells to supermarkets and supermarket puts their own branding. So some generic understanding which I am taking from here is that Halfpenny's branded bread targets customers who want our bread. We have been in the market for a long time. So we have brand loyalty. Remember that. Halfpenny has chosen to make and brand its own products, which means we retain our quality. Anything which has our brand is my own production. So I'm retaining my own quality. In this industry with shrinking demand, because as we know, majority of our products are in the growth stage. Demand is shrinking. Halfpenny may benefit from beyond budgeting principles. Beyond budgeting is a P1 concept. focusing on relative targets and adaptive management, new innovations in budgeting as well, because we want to come up with new products. They will need new budgeting systems as well. So beyond budgeting needs to be considered over here. The market for pre-packaged bread has declined over the past 5 years. This is partly due to a switch towards fresher artisan bread and partly because of an overall reduction in demand for bread due to health reasons. Both of these we have considered in our industry analysis as restraining factors. Again, linear regression coming into the picture over here. Regression analysis. Halfpenny could use regression analysis to forecast future sales declines because we have been in the market for 134 years. We have all of this market data. We have survived booms. We have survived recessions. So how do we come up from it? By looking or forecasting on regression data so that we can plan production in a better way. Your regression coming into the picture over here, forecasting coming into the picture over here. Also IAS 36, impairment of assets coming into the picture, because with declining sales volume, Halfpenny may need to test for impairment of its plant and equipment. Can be a situation in the exam altogether. Sales are declining. We want to check the impairment of our plant and equipment. So impairment of assets comes into the picture. Also IS2, falling demand increases the risk of obsolete inventory. You may need to write down your inventory to net realizable value, for example. So IS2 knowledge already covered becomes important in this situation. So the same topic will come up multiple times in the pre-scene, but in different ways, giving you different avenues to think of, giving you different areas to be aware of. After that, they've given us an article which says Future Trend Series, Innovations Shaping Bread Production. So this is like an article in the Keelan newspaper, fictional again. They've presented information to you as an article. So Bread Tech Digest, what it's called, Innovations Shaping Bread Production. So as food production continues to evolve, bread, one of humanity's oldest and most fundamental food staples, remains at the forefront of innovation. Halfpenny very clearly will have to explore functional bread offering health benefits aligned with consumer expectations, because if we don't innovate, we will not be relevant in today's market specifically. So our industry is witnessing a transformation driven by technological advancements, changing consumer preferences and sustainability considerations. So over here, your transformation, which means effective change management within the business E1 syllabus, will be important. Investment might be needed in new technology, new machines. Again, IFRS 16, you could lease the machine rather than buy it. So an important aspect. Very important new topic coming up, investing in innovative production processes may qualify Halfpenny for R&D tax credits. Reducing your tax liability. Tax is a very important part of your F1 syllabus. Situation could come up where they say, because you are investing in new technology, the government is giving you a 10% tax credit, for example, or 100% depreciation allowance in the year of purchase. You should know what this means. You will only know it if you have studied your F1 syllabus, and I'm giving you instruction to go back and study this because this can come up in the exam. Now that has got me to the end of this pre-scene analysis part 1. This is only one part. There is part 2 with all the details about Halfpenny. There is part 3 with all the financial analysis, coming up to total 3 hours of explanation. Once you've done my pre-scene, you don't have to look at anything else, because as you can see, so much detail is covered, so many topics are covered, so many situations are covered, that if you only do these situations and then write my mock questions on these situations, your exam is going to be straightforward. We are registered tuition providers. We hold the Excellence Award for 2 years in a row. We know what we're talking about. You are in the right place as long as the material is followed well. Hard work goes without saying, but directioned hard work, right direction is most important, and that is what we aim to give through our courses. If you would like part 2, part 3, mock exams, our ICANN statements, all of that, just write to us on help@fintutors.com. We will help you out. If you have any generic questions as well, email us. We will help you out. If you want to sign up to our study courses, you can visit our website finnutors.com/OCS. There are different options. You can sign up for them and have instant access to our material and start studying today. Good luck for your exam.